Wall Street is quietly pulling off one of the most brutal sector rotations we've seen all year, and if you're only looking at the S&P 500 being up 1%, you are completely missing the real story. This week, we saw a historic meltdown. A massive AI hedge fund dubbed Situational Awareness just collapsed, forcing a multi-billion-dollar fire sale of semiconductor stocks and sending the semiconductor ETFs down over 4%. But where did those billions go? The smart money is panic buying two things: proven software and dividend value. Earnings just proved that companies renting out AI cloud space are making billions, while the hardware sector is facing a severe reality check. Today, we're going to look under the hood of the market to show you exactly where the capital is flowing and how you can position yourself for the week ahead. We'll start off by reviewing the heat map, and as you can see, there isn't too much going on here, apart from software, which is completely standing out in comparison to the rest of the market, and that is for both the software infrastructure and the software application sectors, and this is the 1 week performance. However, before we look at software, let's look at the broad market, and on the weekly, the S&P seems to be finding some support on it. The issue, however, is that the baseline is flat and the conversion line is also flat, and typically what that means is that there is a lack of momentum, and if price was further away from the Tenkan, you could anticipate for price to come back down to the Tenkan line. However, as price seems to be sitting on the conversion line here, if we start to get any closes below, we could anticipate price to come back all the way down to the baseline here. And for what it's worth, we're starting to get a bearish twist on the daily, but we haven't broken down below the clouds, so we must remain bullish for now. The S&P closed up at over 1%. The Dow Jones is also up 1% on the week, which would make you think that this is a healthy market. However, the equal weighted Russell is only up 0.67%, and this divergence is a classic footprint of capital consolidating into select pockets. And when we see this kind of divergence, it typically means that investors are flooding to the larger cap stocks. From a technical perspective, however, there's absolutely nothing wrong with this chart. This right here is an indecision candle, and on the daily it looks like we might start to get a bearish cross here. The lagging span is getting close to touching price. However, it doesn't mean that this is the end of this trend. As you can see on the S&P, we've had a bearish cross right around here, and it doesn't necessarily mean that we are breaking down. It just means that we need to be patient and analyze the consolidation to see if it might break bullish or bearish. And for now, the baseline is above the conversion line, meaning that we're waiting for another cross and for the cloud to turn bullish. The Dow Jones also had a bearish cross here, and as discussed earlier this week, the Fed decided to maintain the target range for the Fed funds rate at 3.5 to 3.75%, indicating that economic activity is expanding at a solid pace despite elevated uncertainty that owes in part to the conflict in the Middle East, where unfortunately it looks like there is no breakthrough. The markets, however, are forward-looking, and while this is the current rate, it is currently anticipated with a 72% probability that we will see a rate hike during the next meeting, which is currently scheduled between September the 15th and the 16th. So it's only natural for the smart money to look for safety. Now let's look at where the real earthquake happened this week, the massive rotation from hardware into software, triggered by one of the largest hedge fund collapses of the year. The semiconductor index dropped by minus 4.2% this week, but has still managed to close above the Kijun on the weekly. The daily does not look any better, as price is below the cloud, lagging span is below price, and the cloud is bearish. The Macron chart looks just like the semiconductor ETF, as it's the largest holding, which still closed below the cloud, despite having an 18% day the previous day. This is exactly why I was suggesting to be cautious and more methodical about buying Micron at this particular point, and that while it did have an 18% increase, and ultimately prices in the cloud or below the cloud, which represents institutional and retail trapped liquidity. The catalyst for the forced liquidation this week was Leopold Aschenbrenner's AI hedge fund collapsing after margin calls. Leopold Aschenbrenner was a former OpenAI researcher, and his hedge fund collapsed from 45 billion to around 10 billion in assets on falling semiconductor stocks and mounting margin calls. He was forced to sell all of his leveraged public stock bets, including hard-hit names like SK Hynix and CoreWeave, and the buyer was Ken Griffin's Citadel, who received all of these stocks at a discount, who funnily enough also reportedly anticipated a surprise quarter point rate hike on Wednesday, which we never got, and a lot of people saw this blow up as a matter of not if but when. And before this month's decline, the fund had posted gains of more than 1000% since its inception in July 2020, with Nebius, SanDisk, Micron and CoreWeave being the fund's top disclosed positions as of the first quarter, who have all shed more than 35% of the net value this month. He had bullish bets in AI infrastructure infrastructure names, but at the same time he had bearish wagers on software companies like Adobe. And this fund blowing up could actually be a good sign for software, as Wall Street saw this weakness and immediately rotated into the IGV software ETF, which closed up at 7.5%. Price is still below the cloud on the weekly, but we've had a breakout on the daily. Lagging span is above price, but the cloud is still bearish, and personally I'm waiting for closes above the neckline here. However, I don't think it's a bad time to look at the constituents of the IGV ETF. And even with big tech, the mags, there were massive winners and losers this week, and it purely boiled down to who owns the cloud. As you can see, the mags closed at 4.45%, with Microsoft and Amazon being the beneficiaries as they were rewarded because they own Azure and AWS, which they can immediately rent out as part of their AI infrastructure, with AWS growing 37% and Azure growth climbing to 43%. Apple beat their earnings, reporting its strongest June quarter on record, with revenue of $109.4 billion, which is up 16% from a year earlier. And despite beating top line estimates, Apple services revenue came in at $30.74 billion, below analyst expectations of $31.22 billion. I've already covered Meta in my previous video, and because Meta and Apple do not possess the public cloud ecosystems, it isn't something that they can monetize. And while Google Cloud revenue grew 63%, it was the fact that their capital expenditures will go from $91 billion to a projected $185 billion at the midpoint in 2026, which really forced the stock to drop, and the free cash flow turned negative due to massive AI spending. As you can see, there is a $725 billion AI capex spend in 2026, with only Amazon, Microsoft and Alphabet being able to monetize their cloud services. Google is still below the cloud. Microsoft gapped up and is looking like it's seeing some follow through. However, personally I'm waiting for an entry here above the neckline, as there is clearly some volume here at that level. Amazon just reported its earnings on Friday, so we have to wait until we see some follow through, and potentially it's a buy for me at this neckline here, having sold Apple after it hasn't made its target. Despite having an almost positive 20% day in the Kospi, everything is bearish, and this might be the evidence that we need to say that we are moving away from hardware and going on to software, as over 40% of the index is Samsung, which looks like this, and SK Hynix, which looks like this. The positive, however, for both of them is that they seem to have reclaimed the neckline here. However, there's just so much overhead resistance here in the Kijun and the cloud here, which represents trapped institutional and retail buyers looking to sell. And looking at the IGV, we might have a setup in DDOG, which has had a breakout of this neckline here from 2021, which I did manage to catch, but I got stopped out with profit. It's broken out here above the original neckline. It hasn't gone too far up, but it looks like it's taken some time and looks to be consolidating around this neckline here, and a close above that would be valid for an entry. Lagging span is above price, the cloud is bullish, and the price is above the Tenkan and the Kijun lines. Paycom software also looks good to me, and it looks like we've had a base here that's been developing for about 262 days, and a close above this neckline here would be valid for an entry, as lagging span is above price, the cloud is bullish, and price is above the cloud and the Tenkan and the Kijun lines. Guidewire software as well, as you can see it looks like it's been building a base, with an entry being valid with a close above the neckline, as the cloud is bullish, lagging span is above price, and price is above the cloud. There might be a very short-term trade here as well in Palantir. If it manages to close above the cloud, I'd probably trade it to the neckline here. However, I'd be very cautious of taking trades so close to earnings. From my screener, there's no change really on XLF, which is financials. There's also no real change on XLV, which is healthcare. EV also flagged up, which we've already discussed. Much of the larger relative volumes were heavily skewed towards the sell side, with DRAM being one of them, as well as semiconductors. The only new addition that looks good in terms of a setup and has a decent relative volume is CGDV, which is the Capital Group Dividend Value ETF, and looks like it might want to break higher. And while most of it is focused in tech, the weightings are relatively equally distributed otherwise. And this tells us institutional money is seeking shelter and looking for dividends and lower valuations, while the hardware trade unwinds for now. My individual stock screener didn't flag up too many stocks on Friday, however I'll share some of them with you now. There's Apple Corporation, which has just broken above the cloud here. Lagging span is above price, but we don't have a bullish cloud yet. I would be cautious that there's earnings very soon. However, aside from that, I would treat it as a cloud breakout, with the resistance probably being here around the neckline. Vermilion Energy, which looks very similar to APA, has a cloud breakout as well. We've recently had the earnings report, so there shouldn't be any surprises in this stock. Lagging span is above price, but the cloud is yet to flip bullish, which means price might consolidate here before reaching the target, but that doesn't have to be the case. And lastly, there is Stanley Black & Decker, which looks like it's hovering around the neckline here, and for an entry I'd probably wait for closes above that, but it certainly has some room to go until we meet some resistance. Lagging span is above price, and hopefully we can confirm price as support, and the cloud is bullish. bullish, and prices above the cloud as well. And with the dust settling from this week's mega cap earnings and hedge fund liquidations, here's exactly what the smart money is watching next week. So next week, the macroeconomic calendar is incredibly heavy, and it will serve as the ultimate test for this market rotation. On Monday, we get the US ISM Manufacturing Index, followed closely by the ISM Services Index on Wednesday. These will tell us if the broader economy is cooling faster than expected. However, the true defining moment for our semiconductor thesis arrives on Tuesday. This is when AMD reports their earnings, and AMD's forward guidance will single-handedly determine if the chip sector finds a floor or capitulates further. We then close out the week with the critical employment report, which would give us the unemployment rate. If you found any value in today's video, please like, comment, share, and subscribe.